What's up, guys? It's almost the end of the year, which means you are running out of time to tax loss harvest. If you haven't done any tax planning, we're going to take a look at tax loss harvesting and if you should consider deploying it before the end of the year. I promise you, you don't want to miss it. Welcome back, guys. Be sure to hit that like and subscribe button if you like today's content. And of course, if you need help with your own financial plan, reach out to us at www.modernwealth.com. That's modern spelt with no vowels, wealth.com. So let's go ahead and dive into it. If you are not familiar with tax loss harvesting, this is where you intentionally sell a stock, an ETF, mutual fund, whatever it may be, in a non-retirement account to intentionally incur a capital loss. And the whole reason why you would want to do this is that, number one, having capital losses allow you to reduce other capital gains that you may have. And number two, if you don't have any other capital gains, then you can use up to $3,000 of those capital losses to directly reduce your income. And if you have any losses left over, you can carry them forward to future tax years. Now, the key to doing tax loss harvesting the right way is that you don't want to simply take an economic loss. In other words, you don't want to simply intentionally lose money for the sake of losing money. If you do this the right way, you can have your cake and you eat it too. So this is how it's going to work. Let's say you own Coca-Cola stock in your portfolio and it's down. And if you were to sell it, you would incur a capital loss. Again, it probably wouldn't be the best move to simply sell it, eat the loss, and sit in cash, right? We don't want to simply just take a loss for the sake of eating a loss. We want to be strategic with how we do this. So what we are going to do instead is we're going to sell Coca-Cola and buy something with a similar return profile so that we can ride up any potential recovery associated with that investment. So in this case, we're going to buy Pepsi instead. Now, after 31 days, if we want to sell Pepsi and rebuy Coca-Cola, we can do so without incurring what is called a wash sale, which I'll break down in a little bit. Now, why did we want to sell Coca-Cola and immediately rebuy Pepsi? So let's just say that Coca-Cola investment was down 10%, and by selling, we could get a $3,000 capital loss. The moment we sell Coca-Cola, in this case, we're going to be able to absorb that loss. And the reason why we bought Pepsi is that, let's say that there's a recovery in the soda industry. We want to be able to ride up that recovery. We can ride that up still and still make money because we bought Pepsi immediately after selling Coca-Cola. That's why this is a having your cake and eating it too type of strategy, because you can still be invested for the long run, but you're being savvy along the way by strategically eating losses as you invest. Now, there's a ton of studies on this, and I will link a specific study from Vanguard in the description of this episode. But in a nutshell, studies show that you can add anywhere from 0.5% to maybe 2% per year in additional after-tax returns by tax loss harvesting consistently. And that might not sound like a lot, but it adds up over time. For example, if you invested $10,000 and earned an 8% rate of return annually, you would have $68,484 at the end of 25 years. However, if you added 2% to that and got 10% instead, you would have $108,347 at the end of 25 years. Now, I know someone out there is thinking, well, why wouldn't I just sell Coca-Cola, eat the loss for tax purposes, and then immediately rebuy Coca-Cola? Well, that's where a wash sale comes into play. The IRS is okay with tax loss harvesting, but you have to play by their rules. If you repurchase that stock within a 31-day window, then the loss that you thought you were going to be able to take gets disallowed. So that is why it is best practice to wait 31 days, and then you can either keep the replacement position, in this case Pepsi, or we can sell Pepsi and rebuy Coca-Cola. So that, in a nutshell, is tax loss harvesting. So now that you have a high-level overview of how it works, here are a few tips to keep in mind to make the most out of tax loss harvesting in your portfolio. Number one, look for tax loss harvesting opportunities year-round. Most people wait until the last month or two of the year to scan for losses in their portfolio. But the reality is that you want to be actively seeking these opportunities year round. Great example with this is 2020 with the S&P 500. If you invested $10,000 in the S&P 500 on January 1st, 2020, your investment by the end of the year would have been worth $11,825. If you are someone who only tax loss harvests at the very end of the year, you would have missed one of the biggest sell-offs in market history where you could have easily harvested thousands in losses. But if you're someone who only checks for loss opportunities December, you would have completely missed that big old COVID sell-off that happened in 2020. Again, this is just one example, but this constantly happens, and this is why it's important to check your portfolio year-round for those opportunities. Second thing to keep in mind is that if you are in a very low tax bracket, where your long-term capital gains rate might actually be 0%, it might actually make sense for you to not tax loss harvest and instead do the opposite and intentionally incur capital gains, since you might be paying zero tax on them. Finally, when you tax loss harvest, you want to make sure that you replace your investment with something similar but not substantially identical. Otherwise, you could be looking at a wash sale. So what the IRS means by this is that they don't want you selling, let's say, a Vanguard S&P 500 fund for a loss and replacing it with, let's say, a Spider S&P 500 fund that is the exact same fund, but just simply a different fund manager. Again, your replacement position can be very similar, but the IRS says that they can't be substantially identical. So there you have it, guys. I hope you found this episode helpful. Be sure to like and subscribe if you like today's content. And of course, if you need help with your own financial plan, reach out to us at www.modernwealth.com. That's modern spelled with no vowels, wealth.com. I'll see you next time.